Right, welcome to the Infinite Banking Concept, the Money Multiplier Foundational Training. So what I'm going to talk to you about here this evening is what is infinite banking, what is IBC, what is Be Your Own Banker. As you can see right here, BYOB is the name of the game, and that's what we're going to be talking about here this evening. So with that being said, if you're brand new, I can't wait to introduce you to this. If you've been watching trainings in the past or been following us at all, hopefully get something new out of this. I kind of put a different spin on it than Chris or Devin or Brent or somebody else might. All right, so the Money Multiplier, mapping out the millionaire mystery. My name is Stephen Nagy. I'll be your money mentor from this point moving forward. And I'll tell you a little bit about myself as we get rolling with this, but I've been doing banking now, infinite banking and privatized banking for about 3 years now. I've helped nearly right at 1,000 clients all across all 50 states and Washington, D.C. at this point start their own banks. And it does start with this presentation. So myself, my team will not even take a call with you to discuss with you any of this unless you've watched this presentation or one of the ones that Chris or Brent has done as well. And we have tons of content and we'll talk a little bit about that. So tonight we're going to talk about money and opportunity. What's going on with your money, how to take back control of your money, how to solve your money problem. Now, what I'm going to show you here tonight, it's not get rich quick. It's not any kind of scheme. You're not going out and building a team and recruiting people or anything. All I'm going to show you here tonight is how to do one thing different, how to make one change. And by making that one change, it'll change everything. And that one change is where your money goes first. So instead of depositing our money into somebody else's bank, we're going to start depositing money into our own bank. And by making that one change, we're not working any harder. We're not working any longer. We're not taking on any more risk. But that one change can change everything for you and your family's financial future. And that's what I'm going to show you here tonight, is not only how to become your own banker, how to create your own privatized bank, but I'm going to start teaching you right now how to start using your own banking system, how to take back control and keep that money within you and your family's financial lives. And everything that's going on right now in this country with inflation higher than it's ever been in my lifetime. The federal government is spending more money than we've ever spent in the history of this country. Trillions and trillions of dollars being spent right now. We're over $30 trillion in national debt right now. With all the policy, all the divisiveness in this country, all the infighting, everything that's going on, COVID, shutdowns, everything. It's more important than ever to understand not only what our money's doing, but where our money's going and what is happening with it. And that's what we're going to talk about right now. And we also teach this on a daily basis here at the Money School and the Money Multiplier. So those of you that are joining me here tonight, make sure you join us the rest of the week for our other webinars that we do as well. They're all free of charge. But what we do is we share our experience. We share what we are doing with investing, things like real estate, things like business, things like self-directed investing, and we share with you. And so we do other webinars as well. So tomorrow, for example, every Wednesday at 9:30 a.m. Eastern, we have what's called What the F Happened. And it's a live stream market update that Chris and I do, just talking about what's going on with the markets, what's going on with policy, what's going on with your money. And this is a no holds bar webinar training that Chris and I do, where we cuss a little bit, we get hot, we get heated, we get in arguments, but it's all about money. So join us tomorrow at 1 o'clock Eastern. We have our Wealth Webinar Wednesday series, where every Wednesday we bring in an expert. We bring in somebody that specializes in entrepreneurship or business or investing, and we bring new strategies and ideas to you. So tomorrow we have a tax professional joining us that's going to talk to you all about how to save more money, asset protection, keep more of your hard-earned money in your pockets. And I'll talk a little bit about that tonight as well. And then at 4:30 every Wednesday, we have Ask Me Anything happy hour, where we grab a drink and we answer any and all of your questions. And we do that with almost all of our teams. So that's a lot of fun. Thursdays, we have business building and precious metals, where we talk about precious metal investing and how to build a business. Every Monday at 1 p.m. Eastern, we have Money Club Mondays, where we talk about real estate investing and private money lending and what that looks like through the Private Money Club. And then on every Tuesday, we have either this foundational training or a specialized training. Last Tuesday, We had Greg Hurling join us and talk all about self-directed investing. So we have a full lineup of webinars every single week. So make sure you join us for those. Those are all live streamed and recorded as well. And I'll give you a link in just a second on how you can access all of those. But at the end of the day, it all boils down to controlling your money, being smart with your money, and learning different strategies and techniques that maybe you were never taught in high school, you were never taught in college, you've never done before in life. And that's what this is all about. So thank you for being here. One thing that I've learned over the years, this is one of my favorite quotes right here. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So a lot of what I'm going to talk about here tonight, maybe you've been told your whole life it doesn't work that way, or there's no way that that's possible. Maybe you've been told your whole life that you should go invest in your 401k, work your job, climb the corporate ladder, be smart. And if you work hard your whole life, someday you'll be able to retire the way that you want to. But whatever it is, I want you to keep an open mind here tonight. Very, very important. Keep an open mind, because what I'm teaching you has been done for over 200 years. What I'm teaching you is nothing new. Just because maybe you've never heard about it before or heard misinformation about it, I'm going to set the facts straight tonight. I'm going to be candid with you, and I'm going to be straight and honest with you. And I hope you're okay with that. I hope you can handle it. And if not, call me out. Put it in the text. Call me afterwards, but call me out on it. But I'm going to be direct and honest with you, and I hope you're direct and honest with me as well. And how do I know that what I'm telling you is factual? Well, I've been doing this now for almost 15 years, working with clients. I've been investing myself. I've been using these strategies myself. And something that I found back when I was a financial advisor, fully licensed, Series 766, 215 variable annuity, something that I learned was a lot of people that want to retire aren't able to retire the way that they want to. And in fact, what we found is less than 5% of people are actually going to be truly successful when it comes to their money, when it comes to retirement. I mean, if I was to take everybody on here right now, let's say there's 100 people on here right now, and I was to say, okay, 5 of you, raise your hands. 5 of you in the crowd right now, stand up. Those are the 5% that I want to work with. Those are the ones that are going to take action. They're going to learn something. They're going to seek it, and they're going to implement it. And those 5% of people are the ones that are going to be successful. And we know this through data. We know this through research and through personal experience. The Social Security Administration tells us that if you take 100 people at retirement age, only 5 of those people are going to be able to retire the lifestyle and the age and the way that they want to, meaning 95% of people in this country, the richest country the world has ever known, more opportunity than anything that's ever been out there before. 95% are not going to be able to retire the way that they want to. That's a problem, and that's a huge problem. And that's why we devote so much time to education, financial education, to teaching you how to take back control of your money so you can be part of that 5% and retire and live the lifestyle that you want to, because retirement's different for everybody, right? Like, who knows if I ever retire or what retirement? Retirement to me is passive income where I'm done with everything else. I can do what I want, when I want. I don't ever have to worry about money ever again. And then I'll start to think about slowing down. But what does retirement look like for you? And that's the important part. So then when we really break this down, well, why are 95% of people not successful? Why do they not financially be able to live the life that they want to? Why does it happen? And we found that it's really due to a handful of different reasons. And these are the ones that I've found personally. So the top 3 reasons that you see on your screen right here: taxes, inflation, and volatility. These are all things that we can control when we understand how to control our money. So we can teach strategies, like I mentioned tomorrow on the wealth webinar, on how to start reducing your taxes, keeping more of your hard-earned money in your pocket, so that we can use that to grow our, whatever we need that for. And we can be smart with our money. There's a reason the tax code book is this big. There's strategies that we can follow that are 100% legal, but it allows us to do more in life. Taxes are killing people right now. Inflation. I mentioned it a minute ago, inflation is at an all-time, in my lifetime, it's the highest it's ever been right now. And all inflation is a devaluation of your dollar. What your dollar's worth today is going to be able to purchase that much less next year and the following year. Right now, we're running at about 8.5% inflation. Real inflation is probably more like 15 to 18%. So what that means is what I was able to buy last year now costs me 8 to 15% more this year. And it's a lot more when we look at things like housing and we look at things like food. So how do we start allowing inflation not to affect us? You know, I don't care if gas is $5 a gallon or $2 a gallon. I don't care if I go to Publix to the grocery store and my grocery bill's $300 or $500. At the end of the day, it's really not that big of a deal. So how do we position ourselves and control our money where inflation, whatever it is what it is. It's out of my control. We can vote. We can pretend like we're going to make a difference. At the end of the day, the powers that be are in charge of this stuff, the Fed. And so we just have to deal with it. We have to learn strategies on how to keep our money moving where things like inflation don't matter. And we'll talk about that here tonight. Volatility in the markets. I mean, right now, what is your 401k doing? How many of you have looked at a 401k statement lately? Most people I talk to, it's way down right now. And if you need that money, if you're getting ready to retire in the next year, 2, 3 years, you don't have time for that money to go down and then go back up. We need that money now. So if you're down and you need that money, well, guess what? You just became not part of that 5%. You're now part of that 95% because you're not going to be able to retire the way and the lifestyle that you want to. Even by reducing your risk in the markets and being very conservative as you approach retirement, I'm talking to people every day right now that tell me they're still losing a ton of money. So how do we be more smart with that? So we're going to talk about that here tonight. And then the other 3 mysteries on why people aren't more successful following the status quo: fear, life. These are things that you can control, but you have to do so with mindset. Because if somebody's telling you, oh, infinite banking is crap, or, you know, real estate investing, there's too much risk, or private money lending, how are you going to do that? You don't know what you're doing, right? There's all these negative people. Oh, you can't start a business. Who are you to think you can go start a successful business? Most people that start businesses lose, right? This is following the status quo. This is listening to negative people. This puts fear in our minds. You know what fear is overcome with? I guarantee you somebody that knows everything about a subject and has a mentor or somebody to help them do it, they don't have any fear. Fear is the fear of unknown. The fear is what's next. Fear is not understanding what your next step in, what the next move is in anything. So we eliminate fear by learning, by education, by surrounding ourselves with the right people, by having somebody that will show you the way, where if you run into a roadblock, you run into a wall and you don't know which direction to go, you have somebody there that's going to help you get past that, over that roadblock. Which way do I go? And that's how you eliminate fear. And then life can cause problems. Things like COVID, nobody expected it. Things like death, divorce, disasters. Life happens. So how do we plan for the worst, right? You always want to plan for the worst, but expect the best. Is that what they say? Expect the best, but plan for the worst. I'm good with that because I have a plan. No matter what happens, I can pivot and it's not going to affect me. So one thing every single one of you can do right now is start looking for ways to create additional income. Because if you're working a job and then COVID happens and now you don't have that job anymore, well, if you have other income streams coming in, even if they're not huge, it can be a little bit of money here and there. But if you have additional income streams coming in, well, if you lose that primary source of income, that job, that business, whatever the case might be, these other income streams will allow us to get over that problem and get our main job, business, whatever it is, back on track. And the other things will help us get there and where it doesn't matter, right? So we have to start planning. We have to prepare. And then when life throws us curveballs, we're ready to line up with that thing and whack it out of the ballpark because it doesn't matter. It's not going to affect us at the end of the day. So these right here are what I found and what we've researched, the main reasons why more people aren't successful, why more people can't retire, why more people aren't financially independent and live that lifestyle that they want to. Every one of these, I can show you here tonight how to overcome it and start planning for the future where none of this will affect you anymore. So let's get into this. But like I said, it does start with mindset. So I'm going to give you some homework as we go here tonight. So here's homework number 1. Number 1, write this down. The backwards bicycle. The backwards bicycle. Write that down. It's like a 10-minute video. You can go on YouTube and find this. Okay. So go on YouTube and type in the backwards bicycle. It's like an 8 or 10-minute video. And what it does is it shows mindset and how we think our whole entire lives one way, and how when we make one little change, we fight ourselves. We mentally fight ourselves, and we mentally prevent ourselves from getting beyond that. And this video right here is a great example, because they take a bicycle. We all know how to ride a bicycle. We've done it our entire lives. And what they did is they reversed the way that the bicycle functions. So they took the handlebars and they reversed them. So now when we go to turn, like we've done our whole lives, the bike goes the other way and you crash. You can't ride the bicycle. And they did this experiment with a bunch of people, and they showed you why it happens. And it's fascinating, but it goes to show us how our minds work. So I want you guys to go check out that video, and then let me know what you think about it. Send me an email, send me a text message, reach out to me on social media. Let me know what you think of that video, because I found it fascinating, and they get into a little bit of the mental aspect of it. Some books that I would highly recommend. Again, this is all stuff that we need to surround ourselves with the right people, with the right mindset. So check these books out. Anything by Robert Kiyosaki. But in his book, Second Chance, Robert writes all about the infinite banking concept and privatized banking, and why he's such a proponent of it. So if you're a fan of Robert Kiyosaki, definitely check that book out. You probably see it. I got all the Rich Dad books myself. Always have been a big fan. I had the opportunity years ago to train and teach with Robert Kiyosaki's Rich Dad Poor Dad company, and it was just an unbelievable experience. And it's really set up a lot of foundation on what I do in business now, what I do when it comes to investing, the way I look at the cash flow quadrant, the 4 quadrants, and everything that I do. It's wonderful stuff. How about Tony Robbins, Money Master the Game? Another great book. Tony writes about the infinite banking concept, what I'm teaching you right now in that book right there. I got that one back here somewhere too, right here. Becoming Your Own Banker. This is like the Bible when it comes to the infinite banking concept and becoming your own banker. So if you want to read a book and just one, start with that, Becoming Your Own Banker by R. Nelson Nash, and then go on anything R. Nelson Nash has wrote. And then Brent and Chris wrote an updated version of Becoming Your Own Banker called Mapping Out the Millionaire Mystery. And they wrote this book a couple of years ago, and it's mind-blowing. Check that out. Actually, that book and the Private Money Guide, what I'm going to do for everybody that's on here right now, would you guys like a free copy of those 2 bottom books? If you want a free copy of those 2 bottom books, I'll actually send you a free digital copy just for being on this webinar with me here tonight. So here it is right there. So go to that right there, moneyschoolrei.com/Snaggy. moneyschoolrei.com/Snaggy. And I'll put it in the chat box, actually. Let me just throw it in there real fast so you guys have it. So what you want to do is go to that site, put in your name and email, and I'll send you, there we go, it's in the chat box. I will send you a digital copy of both of those books right there. And get started on them, get started reading them. And then that combined with tonight's training, you're probably going to want to schedule a call with me also, so we can talk about your personal situation. I can answer more of your questions. So you'll have an opportunity on there to schedule a call. My calendar does get booked out pretty far because I have some trips coming up. I'm speaking in Cleveland on Thursday. I'm speaking in Dallas, Texas on Friday. Next week, I'm speaking in Lafayette, Louisiana, and then I'm speaking in Orlando, Florida, coming up in the next couple of weeks as well. So get on my calendar and get that scheduled, and we'll talk about your situation and what we can do. But I just wanted to get that out there early in case anybody has to hop off early tonight. You still can get a copy of those books, some other resources, and schedule a call with me. And then, of course, this is my cell phone and email. If you need anything at all, do not hesitate to reach out. I want to be your money mentor from this moment moving forward in your financial education and becoming your own banker journey. Okay. All right. So like I said before, I've been doing this now for about 15 years. I was a personal financial advisor at a college, was in that for a couple of years, and learned about entrepreneurship, learned about real estate investing, and learned the mindset of a millionaire. And I learned that if I can go out there and create something, I can go out there and start a successful business. I can go out there and provide value to the world, that I'll have a lot of money coming in. And then if I'm smart with that money and I invest it wisely in things like real estate, things like private money lending, things like notes, things like other businesses and startups. And then if I can be very smart about my money and also protect it and take advantage of things like uninterrupted compounding interest, which I'm teaching you here right now, then I can create success and create it a lot faster. And then every time I've ever learned something new and done it myself and created that success, I've always wanted to go share it with other people. So it's one of the reasons I think why I became a financial advisor out of college. And it's one of the reasons why I love what I do today. Webinars, trainings, talking with clients all day on the phone, traveling, speaking on stages across the United States. It's a passion of mine. I absolutely love it. And I think that comes out. If you agree with me, let me know. But it's something that I've always done. So I've had an opportunity to be able to do this and continue to do it to this day. But my family and I live down in South Florida in the Jupiter area. If you're familiar with Southeast Florida, Northern Palm Beach County, that is my wife and my son, Bryce, on the screen right there. All right, let's get into this. So how does money flow? So when we're talking about infinite banking and we're talking about controlling our money, there's a couple concepts that we really need to understand. So compounding interest is a very important concept. Spreads are a very important concept. How banks work is a very important concept because we're going to start mimicking what banks do. So let me explain to you exactly what I'm talking about here. So let me ask you this question on the screen. Can you make money earning 4% while paying 6%? What do you think? Yes or no? Can you make money earning 4% while paying 6%? And while you're answering that question, let me set this up for you. So let's just say that I wanted to go buy a car, and that car is $25,000. And I have $25,000 sitting at a bank in a savings account. Well, what are my options if I want to go buy that car for $25,000? Well, I could go to my bank account and I could take the $25,000 out and I could go buy that car. I could get a loan for that car. Okay, I can go to the bank and get a loan for that car. I can lease that car, which is basically renting the car. Or are there any other options? I mean, those are the three main ones, right? Or what I do when I buy cars now, and what I'm going to teach you to do, is the fourth option, which is finance that car, but we're going to finance it from my own bank. Okay, because think about it. If I buy that car with cash, what am I doing? I'm giving up the power of that cash to make me more money. So I now own the car. I'm not giving interest to anybody, but my $25,000 that could have been making money for me is now gone. If I finance a car, I'm just giving all that interest to somebody else. If I lease a car, I'm giving all that money to somebody else. But if I go to my own bank, it's going to allow me to do what the banks do. So I'm going to show you that in just a second. But let me teach you something real fast called spreads, okay? And then we're going to talk about compounding versus simple interest. So if I take that $25,000 and I was to go to a bank and finance that vehicle, they would typically finance it at, let's say, 6% over 5 years, 60 months. My monthly payment would be $483 a month. And then at the end of those 60 months, I now own that car free and clear. But I gave all that interest to somebody else, right? So the total of that $25,000 is going to be $29,000. So I basically paid $4,000 out in interest over those 5 years. So over here, we have $25,000 at 4% over the same 60 months. So over here, I'm paying 6%, but over here, my money is earning at 4%. But check this out. Over those same 60 months, my $25,000 grew to be just over $30,500. So the same $25,000, the same 60-month time span, but over here I'm paying 6%. And at the end of your 5 years, $29,000. Over here, I'm earning only 4%, but my money grew to be over $30,500. So think about this. My money earning 4% just made over $1,500 compared to me paying 6% over here. Why does that happen? Well, this is a simple interest depreciating loan, okay? So every time I make that monthly payment, it reduces the balance of the loan. So every time the money so every time I'm paying 6%, I'm paying on a lower loan balance. But what's going on over on this side of the screen? This $25,000, even though it's only earning 4%, a lesser interest rate, it's growing more over 5 years because of compounding interest. Because over here, every time my 25,000 earns 4%, it increases the balance of that $25,000. So 1 year it's 25, then it's 26, then it's 27, then it's 28, then it's 29, all the way till the 5th year. We now have $30,500 sitting there. So I give you this example because it's important. What I'm going to show you tonight, we're going to talk about spreads, and we're going to talk about how banks work. And this is exactly how banks operate. We can make money all day long earning 4% while paying 6% as long as we do it the right way. So keep that in mind, because this is an important aspect of this concept. So what is the money multiplier method? Well, first off, we have the machine. Second off, we have the marathon. And third and final, we have the millionaire. So we're going to talk about right now, what is this machine and how does it work? This is not a get rich quick. I said that earlier, but this is being smart. And if you're smart and you follow the marathon and you use this machine, who doesn't want to be a millionaire? Who doesn't want to be a multimillionaire? There's a reason multimillionaires use this exact same strategy. And this is exactly what I'm going to show you right now. So let's dig into it. What is this machine? Well, this machine is nothing more than a dividend-paying whole life insurance policy from a mutually owned insurance company. So that's what our new bank is going to be built on. Our new bank is going to be built on a whole life insurance policy from a dividend-paying mutually owned life insurance company. Now, let me clarify right now what I'm talking about. This is not a life insurance policy that you call your brother-in-law or somebody from high school or your networking group to do for you. This is not an IUL. This is not term insurance. This is a specially designed and engineered whole life policy built for banking purposes. This is a banking policy. This is what myself and my team and the Money Multiplier do all day, every day. So we are the ones that are going to create, design, and set this up for you. Okay. This is all we specialize in. If you hurt your leg, you go to the doctor. If you have something wrong with your knee, they send you to an orthopedic surgeon. Then that orthopedic surgeon is going to go in and a specialist is going to do the surgery, right? Well, this is what we do. This is a specially designed and engineered whole life policy. I just want to make that very, very clear. The good news with that is it's a dividend-paying mutual company, and the companies we use are some of the best in the country. They have the highest rating, the best financials, the best of the best. Why? Because where do you want to warehouse your wealth? With the best of the best, right? Why a mutually owned dividend-paying insurance company? Well, because the IRS, the government gives us rules that we operate within when we create these policies that allow us to take advantage of everything I'm getting ready to show you. So these are specially designed. So I just wanted to make that very, very clear. If you want to see an example of what this looks like, check out something called BOLI, Bank-Owned Life Insurance. BOLI. So more homework. Go check this out later. Google BOLI, Bank-Owned Life Insurance. And like I said before, all we're doing is we're mimicking what the wealthy do. We're mimicking what the banks do. And we're going to design these policies for banking purposes. So we'll get more into that in just a second. So that's what the machine is. So who else uses this machine besides the banks for their wealth? Well, how about Jim Harbaugh? Any college football fans, you guys saw him coaching the Michigan Wolverines this weekend. Jim Harbaugh is one of the highest paid football coaches in the country. A large portion of his pay comes in the form of deferred compensation life insurance policies. You can read it right here. This was a news article from 2016. In August, the University of Michigan announced that it had amended its contract with head football coach Jim Harbaugh to include a creative deferred compensation alternative involving cash value life insurance. made him one of the highest paid coaches in the country. Who else? How about Joe Biden, the president of the United States of America? Biden holds 4 checking accounts. In addition, he holds 6 life insurance policies with Mass Mutual, one of the mutually owned insurance companies that we do business with. He probably has more than that, but these life insurance policies, they're protected, they're private, nothing has to be disclosed. Who else? Walt Disney. Walt Disney wanted to start Disneyland after failing this pursuit of traditional means of financing to build what would become Disneyland. Walt decided to provide his own financing. A large part of this came to be by collaterally borrowing money from his cash value life insurance. The Pampered Chef. Doris Christopher started the Pampered Chef in 1980 from her Chicago home. Today, the company boasts 12 million customers, and Warren Buffett acquired it for $1.5 billion. She started it with $3,000 from a life insurance policy. Ray Kroc of McDonald's, same thing, as well as some of the wealthiest families in the country, such as the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers. They've all been using it for years and years and years. Now it's your turn. So how do we do this? How do we start mimicking what the banks do and becoming your own bank? So to mimic what the banks do, we have to understand how banks operate. So when you take money and you deposit it at the bank, let's say you have $100,000, you go down to the local bank, you put it in an account, savings account, checking account, business account, whatever the case might be. So you stick the money in there. The bank then, if we're lucky, pays us a little bit of interest in a savings account. Now, lately, the interest has been basically zero. In the past, 3-4%. It doesn't matter. These rates, these amounts don't matter. All we're looking at is the spread, okay? So when you go and you take that $100,000 and you put it at the bank, what does the bank now do with that money? What do they do with it? Do they let you sit it there in a safe deposit box and wait for you to come get it back? No. The bank takes that money and they immediately put that money in motion. And the way they do that is through loans. So let's say you want to buy a house. Well, you go down to the bank, you apply for a home mortgage, and the bank approves you. They give you that money. Let's say it's a $100,000 mortgage. The bank gives you that money. You take that money, give it to the seller. Then what's the seller do with that money? They put it right back in the bank. Same thing. Then let's say you got to buy a car. Go down, get a car note. The bank takes that money, or you take that money, you buy the car dealership puts it right back in the bank. Just moving the money, right? Home remodel loan, debt consolidation loan. So the bank offers all these different types of loans to move the money so they can make what's called a spread. Because think about it. If they're paying you 4% in your savings account, and then they're charging you 7% for that home loan, what did they just do? They made a 3% spread on their money. Car note, same thing. Lend it out, they make 4% there. Same thing with the remodel loan, they make 5% there. Same thing with the debt consolidation loan. They're paying you 4%, they're making 12, or they're charging 12%, so they're making an 8% spread. So at the end of the day, the bank takes your money, they lend it out on a home loan, on a car note, on a home remodel loan, on a debt consolidation loan, and they're simply making spreads off of your money. So this example right here, they just made a 20% spread. They just made 20% off of your money, right? Think about it. They're paying you 4%. Add all that up, they're making 20%. So they just made 16% spread off your money. Is that right? No, the bank actually just made 500% off of your money. Think about it. If they're paying you 4% and they're making 20%, that's 5 times more. That's 500% more they're making on the money that you're depositing into their bank. Why? Why are you making the banks rich? Do banks know how to make money? Absolutely. That's what banks do, is they make money. So why are we making banks rich? Why are we giving them our money? Why are we putting our money there so they can use it? Why aren't we doing this ourselves? And the answer is usually easy. It's nobody's taught you how to set up your own bank. Nobody's taught you how to create one of these policies that you can use that mimics what the banks do. And that's exactly what I'm going to show you right now. But again, we got to understand how banks operate so we can mimic what banks do. But that's all we're doing, guys. That's all we're doing is mimicking what these banks do. And you don't have to take my word for this. More homework for you. Go check this website out, BauerFinancial.com. Bauer Financial, this is all they do is research banks, look at their balance sheets, what they invest in, how they operate, and they publish all this information. And right on BauerFinancial.com, banks make between 400 and 1,300% on money that you leave there. So if we're giving banks our money and we're giving all the interest and they're making all this money off the interest that they charge and 500% off of our money, well, how do we start keeping that, right? How do we start recapturing that and using this new account just like the banks use your money? So to understand that, we got to kind of look at where our money is going right now, okay? So when we look at the annual pattern of spending, how people spend money, all right? So if we take a dollar bill, on average in this country, every 20 cents of every dollar that you earn goes towards an automobile, okay? So every 20 cents that we earn of every dollar that we make, 20 cents of it goes to an automobile. 30 cents of every dollar that we earn goes towards housing. 40 cents of every dollar that we earn goes to everything else. So kids, travel, food, other expenses, whatever, everything else, 40 cents. So that leaves us with 10 cents. So on average, 10 cents of every dollar we earn goes to savings. And that's after everything else is paid out. So most people get their paycheck. The bill goes to the automobile, the bill goes to the housing, the bill goes to the credit cards, the bill goes to this and that and that. And then whatever's left over, we're like, okay, well, I got about 10 cents left of that dollar. Let's go ahead and save that, right? Now, let me show you what banks do. Let me show you wealth people. Let's show you, what if we reverse engineer this? What if we first save that 10%? You okay with that? Why give everybody else all our money and forget about us at the end? We keep at the end of the day. How about we save the money first? Okay, so check this out. What if we take that 10 cents and the first thing we do with it is we put it into our savings? Now, what does the rest of this look like? All right, because of that 20 cents that goes to automobiles, on average, 5 cents of every dollar, 5 cents of that 20 cents goes to interest. Okay. So what if we, instead of giving that interest to somebody else's bank, what if we give that interest back to our bank? Because we already have the savings, we're paying ourselves first. So what if we keep that 5 cents in interest we're giving to other people and we put that into our bank, our savings account? Well, by doing that one thing right there, instead of paying someone else's bank, we pay our bank first. We just increased our annual savings by 50%. Just think about it. If we're saving 10 cents before, and now we add an extra 5 cents on there, that's a 50% increase in savings by doing one thing different. So what if we do that with some other things? What if we do that with housing? Did you know on average, 25 out of every 30 cents that goes to housing goes to interest? How can it be so much? Think about it. A 30-year mortgage in this country, over 90% of the interest on a 30-year mortgage is paid in the first 7 years. On average in this country, somebody is going to either, a homeowner is either going to move or refinance on average every 7 years. You got it. So if people are moving or refinancing every 7 years, and we have this due on sale clause in our mortgages that make us start a new mortgage every time we move or buy a new home, or we refinance because they got some new rates out or whatever. Again, the banks know how to make money, right? Do you think that there's a reason why the banks want you to get a new mortgage on average every 7 years? Why they want you to move on average every 7 years? Yeah, because they're getting 90% of their interest in those first 7 years. They don't care after that. So 25 of every 30 cents is going in housing is going to somebody else. So what if we keep that money in our own bank instead of somebody else's? And then if we look at everything else, the 40 cents on average, 5 cents of that is going to somebody else. So why don't we just recapture that 5 cents while we're at it as well. So by not doing anything different except paying ourselves first and changing who we're giving all this interest to, we just increased our annual savings from 10 cents to 45 cents. You okay with that? So let me show you exactly how we do this. So here is the machine. I'm going to show you how to get all the money back for every car you'll ever buy, drive, and own. But before we do that, let's look under the hood of this thing. So I'm going to show you under the hood of one of these specially designed and engineered whole life policies. And while showing it to you, I'm going to show you how to recapture all the money for every car that you'll ever buy, drive, and own into the future. Okay. So here we go. So over on the right-hand side right here is what we call a policy illustration. So it's going to show you all the pertinent information about your policy, about your new account, this new life insurance policy. So we have the policy year, we have the age of the individual, and then we have the deposits. So what are those deposits? Well, those deposits are what in the insurance business are called premiums. But more homework for you. I want you to challenge yourself from this moment forward. When we talk life insurance, when we talk your new money multiplier policy, you're not paying premiums into it on a regular basis. You're depositing your money into your new bank. Okay. No more premiums. These are now deposits. And the reason for that is mental. Because if I have like a car payment or a premium that I have to pay, or like my health insurance premiums have like a negative connotation. We're like, oh man, I got to pay that bill, or I got to pay that premium or whatever. But if you just did a wholesale deal and made $10,000, or you just cashed out a business and made $100,000 or whatever, you got a nice paycheck at work and you got a nice chunk of change and you're going to go to the bank. Well, you're excited, right? You're driving out of the bank, or you're pulling up your phone and you're doing mobile deposit, but you're excited to deposit that money into your bank account. Why? Because once it's in there, now you can pull out your debit card, you can go to the ATM and you got cash to spend, or you can go do whatever with it, right? Or you feel good because you got a bunch of money in your bank account now. Why are we excited to go put money in someone else's bank account? Let's get excited to put that money into our bank, our new life insurance account, right? So that's why I want you to change your mindset a little bit. And as you start to realize when you're depositing money into your own bank, you're not paying a premium, it's going to start to make a lot more sense as well. So from this point forward, anytime you hear me talk about premiums, that's what they are. It's a premium for this policy, but it's now actually deposit it into your new bank, because you're going to be able to use this money immediately. Immediately. The money you're depositing in, you're going to be able to start using it immediately. And I'll show you that in just a second. All right. So back to the policy, policy over here. So we have the car loan repayments. I'll show you that in a second. Over on the right-hand side, we have the death benefit. And something I want to mention also, the age does not matter. So this is a policy for a 26-year-old, but you can be 6 months old. You can be 70 years old. It doesn't matter. We're building this policy for banking purposes, not the death benefit. So while there is a nice death benefit, it's nice to have it on there. It'll go to your beneficiaries one day, tax-free. That's not why we do this. We do this for banking purposes only, okay? So if you're older, if you're younger, or if you're just not healthy, this is life insurance, so you do have to qualify for it. So let's just say you're not healthy. You just had cancer, right now. You have active cancer, whatever. Maybe you're 80 years old. Maybe you're a minor. Well, minor's different, but whatever reason, you just can't get a policy. Well, we can use somebody else's life. If you're a minor, you just have to have the parent own the policy until you can transfer it to the child whenever they become of age, if you want to. So we have solutions for this stuff. So age doesn't matter. Death benefit, health doesn't matter. Just talk to me about whatever your situation is, and we have a solution for it, okay? So I just wanted to make that very, very clear. Let me show you how to start recapturing this money, all right? So the money going in, these deposits, this person decided to put $10,000 a year in. The other thing is those deposits, those premiums, those deposits, that is up to you. You tell me how much you want to deposit into this policy, and we're going to design it and build it around that. So as a guideline minimum, we're going to tell you at least 10 times your age on a monthly basis. So if you're 35 years old, at least $350 a month. If you're 50 years old, at least $500 a month. So that amount or more is good for your first policy. Also, you can dump in extra money up front. I'll talk about it in a second, things like that, but whatever. Just know it's up to you how much you're putting in. This example, this 26-year-old wanted to put $10,000 a year in, okay? All right, so here we go. So they start putting $10,000 a year in. In the third year of this policy, they want to purchase a car for $25,000. So the cash value is the amount of money in the policy that you can pull out to use. So in this case right here, in the third year, they pulled $25,000 out of the policy. They now have $4,000 available in there because they pulled $25,000 out. And they purchased the car. And then, like I said this before, once you purchase the car, we always want to be what we call an honest banker. So if you were going to take a loan from someone else's bank, you would pay that loan back normally, right? So if you take a loan from your bank, is it smart to pay that loan back? Absolutely. So we're going to encourage you not only to always pay yourself first, but pay yourself back with interest. Because if you pay someone else's bank interest, why not pay yourself interest? So that's exactly what we're going to do. So over the next 5 years, we pay ourselves interest and we pay ourselves back $6,000 a year over 5 years, just like a normal car loan. So at the end of 7 years, we put $10,000 into this policy. We've recaptured $30,000. We took $25,000 out to buy the car. So we have a total of $75,000 we put into it. So you can see right here, we have $67,000 sitting in our account. So I put 75 in, I have 67,000 in there, and I have a $25,000 car parked in my driveway, free and clear, paid for. So I just recaptured 91%. 91 cents of every dollar I put into this thing, I've now recaptured back. But I told you a second ago, so not bad, but I told you a second ago, I'd show you how to recapture 100% of all the money you're going to spend to buy, drive, and own cars in the future. And here's the best part is this doesn't stop after 7 years. This thing continues to compound and grow. And when we get to this point, this is when it really becomes efficient as well. So let's keep going with this. Now, in policies, you're never going to stop putting money into it. Why would you? It becomes more and more efficient every year that policy compounds and grows. But for the simplicity of this, I just want to show you how it works, where if you put no more money into this thing ever again, how it still is going to allow you to recapture and get all that money back for all these purchases. All right, so let me show you. So we put no new deposits into this thing, but in the 8th year, we buy another car for $25,000. So if we make a purchase, again, we're going to be an honest banker. We're going to pay ourselves back with interest. So over the next 5 years, we're going to pay off that car loan to ourselves. So we put no new money in. We recaptured $30,000 into the policy. We took $25,000 out to buy the car. So what do we do there? Look at the 7th year. We had $67,000 in. Well, that policy grew to be $91,000. Remember, we put $5,000 into it, but no new deposits. It grew by $23,000. So look at this right now. We have $91,000 sitting in our account. We have 2 vehicles bought and paid for. We're $50,000 sitting in the driveway. We're putting no new money in. And our account is sitting there compounding and growing for us every single day. And we have $91,000 available to make our next purchase with, to make our next investment with, to use it however we want to use it. 2 vehicles bought and paid for in the driveway. Did I mention that? I'd say we've recaptured all of the money we spent to buy those 2 vehicles and some. And if this works with cars, what else can it work with? But again, this example works on 3 concepts. Rule number 1, pay yourself first. Rule number 2, pay yourself with interest. And rule number 3, recapture and recycle your money and do it over and over and over again. Just to reinforce that, pay yourself first, pay yourself with interest, always recycle and recapture your money. And if this works for a car, what else can it work for? And here's the biggest difference, especially when it comes to these rules. The rules are rules. So we recommend you follow them, but guess what? You're the banker. You're in charge. So whatever these rules are, you set them. So that car loan, that $25,000 car loan that we gave ourselves Well, let's just say you're in the third year of that thing and something happens at work or something happens financially or in your life and you're just struggling and you can't pay yourself back that car loan. Well, if you don't pay back Ally Financial or Wells Fargo or BMW or whoever, what are they going to do? They're going to send a tow truck to your house and they're going to repossess that vehicle. Well, if I don't pay the car loan back that I gave myself, I'm the banker. I'm in charge. So am I going to repossess my own vehicle or am I going to cut myself some slack? It's up to you, but I'm probably going to cut myself some slack. I'm in charge of this entire thing. If I need to pause my payments for a while, I can. If I need to reduce the amount that I'm saving, that I'm paying myself first, I can do that. If I just want to wipe the loan out, unlike the president, I can legally wipe out my loan legally by myself. I'm in complete control, and that's the bottom line. So these are rules that we want you to follow in doing infinite banking, but at the end of the day, they're more suggestions because you're in charge and how you do things is completely up to you. All right? So that's making major purchases. And again, if you can do it with a car, what else can you do it with? Think about your business. Does your business have any major purchases it needs money for? You real estate investors, I'll show you an example of that here in just a second. Boats, airplanes, other expenses. What else can you use it for? So that's one way to be your own banker, is recapturing money that in interest that otherwise you'd be giving to other people. But how about debts? This is another way to become your own banker. This is almost like the ultimate debt consolidation loan, so to say, but without the debt consolidation loan part of it, because I'm not a fan of debt consolidation loans at all. But how many of you have debts? Let me show you how this works. This is really mind-blowing stuff right here. All right, check this out. All right, so this is an example of a real doctor. This was a chiropractor, an actual client. It's probably been about 10 years ago now, but this was a client, chiropractor, and this is a real policy. This is a real debt map, everything. So this chiropractor found himself in $478,000 in debt. He was paying out each month $5,777, as you see added up right here, to third-party debtors, almost $70,000 a year. If he would have continued on this path, it would have taken him 19 years to pay off all this third-party debt. So here's what we did. We started a policy for him, putting $25,000 a year into it. The first year that he put $25,000 into his policy, he had $14,800 in cash value available to take back out to use. Now follow me here. Remember before I was talking about the cash value. So we have the deposit column, the money going in. We have the cash value column, the amount available to take out to use. And we have the death benefit column. And the death benefit is going to increase each year as well. So keep those in mind as I explain how this works. So when he puts $25,000 in the first year on this policy, he was able to take back out almost $15,000 within 30 days, immediately can pull it back out. And that's exactly what he did. He took that $15,000, he paid off the Discover card, he paid off the Lowe's card, and he paid down the Nordstrom card. So by doing that, we eliminated $448 a month that was before going to Discover and Lowe's, and reduced his annual payments to other people to $5,329 from $5,777. Now, make sure you're following me. We are no longer paying that $448 to Discover and Lowe's. However, what are we going to do with that $448 a month? What do you think? Okay, so William said, use that money to repay your loan. Michelle said, put it back in the policy. Michael said, pay off other bills. Katie said, pay yourself back with interest. Absolutely. Okay, so you guys are spot on. All right, so what we're gonna do is we're gonna take that $448 a month and we're gonna recapture it back into our banking system. So now $5,300 a month is going to third-party debtors, and $448 a month is going back to our bank. Year two, we put $25,000 in. Now in year two, you'll look at the cash value available is a little bit higher. So the first year we had $14,000 available. Now we have $16,000 available. And you'll see this every single year you have this policy, the cash value available is more and more and more, and exponentially so later on because of the compounding interest aspect. So in the second year, we now have $16,000 of the $25,000 available. So what do? We immediately pull that $16,000 out and we use it to start tackling more debt. But Remember, we don't just have the $16,000 available. We also have $5,300 of recaptured payments. That's that $448 a month. You guys said you were going to recapture back into your bank. Absolutely right. So the $448 a month throughout the year is now $5,374. So that combined with the cash value from the policy, we now have $22,000 in year 2 that we can use to tackle third-party debt. So we pay off the Nordstrom, pay off the Wells Fargo, pay off the private loan, and reduce the BMW. Same thing. $3,800 going to third-party debtors. We now have $1,900 a month going back to our bank. So year 3, same thing. 25 goes in. Check out year 3. We now have 25,000 of the 25 we put in to pull right back out to use. The recaptured payments of 23,000. So we now have 48,000 to pay off debt. Bye-bye BMW, bye-bye West Marine, and reduce the balance of the condo. 3,600 going back to our bank each month, 2,100 going back to the third-party debtors. Let me make sure you're following so far. So far, we've put $25,000 into the policy each of the first 3 years, total of $75,000. We've taken out 14, 16, and 25 for a total of $55,000 out of the policy. So if we put 75 in and took 55 out, how much do we have left in the policy? Put that in the chat box. We put 75 in, we took 55 out to pay off third-party debt. How much do we still have in the policy? What do you guys think? All right, so we actually have $75,000 remaining in the policy. And the reason that happens is because when we use that cash value, when we take money from the policy, we're not actually taking our money from the policy. What we're doing is we're actually taking a loan from the policy. Our $75,000 we put in there acts as collateral for the insurance company, and then the insurance company gives us a loan from their general account so we can use that money. And the reason we do that is that allows all of our money to remain in the policy, compounding uninterrupted for the rest of our lives. And then we take the loan from the insurance company's money to use it. Okay. And all the insurance company is doing is using that policy as collateral, because remember, when we borrow against the policy, we're really borrowing against the death benefit. Because I said before, you're in charge. So if you never pay these loans back ever, the insurance company doesn't care, because they're just going to reduce the outstanding loan amount from the death benefit before the death benefit is paid out. So they don't care. They're paying that death benefit out one way or another. So what do they care if it's $100,000 or $50,000 because you had $50,000 in loans out against the death benefit? It doesn't matter to them. So that's why that works that way. And that's what allows us to keep all of our money in there, compounding and growing. And then the recapture of the money, that goes into a segregated account throughout the year. And we can talk more about that in a second. But all right, so year 4, same thing. 25 goes in, 26,000 now available, 44,000 in the recaptured payments. So we take that $70,000, we reduce the balance of the condo down to 26,000. Year 5, 25 goes in, 27 available, 44, 71,000. Okay, now the condo's gone. Now we only have the house remaining. Now check out what happens here. Year 6 of this policy. So now what happens is in year 6, and again, your policy is going to be a little different. Your policy, this is going to happen to probably in year 11. This is about 10 years old. So they've changed a little bit over the years and we've gotten better at building them. So, but nonetheless, still works great. But in year 6 of this policy, the chiropractor was forced to only put $10,000 into his policy. He was not allowed to put $25,000 into it anymore. And the reason for that is something called MEC rules. So the IRS regulates how these policies operate and function. So when we design and build a policy for you, we have to abide by the MEC rules and the rules that the IRS sets, and to keep this thing tax-free, to keep the loans tax-free, to keep the death benefit tax-free, to keep the growth within the policy, the compounding of it tax-free. We have to abide by these rules. And one of those rules is they tell us how much we can put into these things. Now, we can design it for you however you want. But in this example, in year 6 of this policy, they were only able to put $10,000 into that first policy. But guess what? You can have essentially as many policies on yourself as you want. So this is when you just start opening up additional policies, stacking policies to build your overall banking system. So in year 6, the chiropractor put $10,000 into his first policy, of that $10,000 that he puts in, it grows by over $13,000. He can pull right back out. That's a 30% cash on cash return on his money in the 6th year of this policy. And then he started a second policy where he's putting $25,000 a year into that one. So he's putting a total of $35,000 a year into these policies now, 2 policies. And then the second policy, because it's a new policy, remember, the cash value is now down to $15,000 again. It takes time, compounding, efficiency. Recaptured payments of $54,000, total cash of $82,000. We take that 82, we pay off the house. In 6 years, we eliminated all of the third-party debt from this chiropractor's life that was going to take him 19 years. He's continuing to build wealth for his family the entire time. So we paid off this debt while his money sits in there compounding, building and growing wealth for him and his family for the future. And now we have $5,777 a month that was going to other people. Then what are we doing with that money now? We're paying that back to our bank, meaning all that interest every single month, every single year for 19 years that we would have been giving to other people. Within 6 years, we eliminated it. And now all of that interest, all of that money is staying within me and my family's financial future for the rest of my life. This is what we call a debt map. So if you like what we did for that chiropractor, we will do the exact same thing for you. So not only do we help strategize with you, what's the best policy, what's the best amount to put into it, what's the best way to structure it. Not only do we design it for you and make sure that it fits your needs and goals, not only do we help you get approved for this, but once you have the policy, we have what's called our mapping team. And our mapping team, mapping specialists are going to put together the debt map, the purchase map, how to move the money, but they're going to show you how to do banking with this thing. See, our work really starts once you have the policy approved and it goes in force and you start it, because then we got to teach you how to actually use it for banking, how to do infinite banking concept with it. So our mapping team is going to meet with you immediately. You're going to take your first loan immediately, and you're going to start using this money for purchases, for debt, for investing, for business, whatever the case might be. And we're right there with you every step of the way, holding your hand and basically doing it for you. So we eliminate the fear. We eliminate the excuses and the issues that you could have. So we're going to build this debt map for you too, if you have debt, or show you exactly what to do with it. It's what I like to call a financial GPS. Where are we now? Where do we want to be? And what is the fastest and most efficient way to get there? Sure, you can get there on your own, stumbling there, but why not follow somebody that does it every single day of their lives, that's been there, has made the mistakes? And that's what this is all about. This is the financial GPS that's going to take you from where you are now to whatever level of success you want, to whatever retirement looks like for you in your life. Let's talk about becoming the millionaire. What if you don't have any bad debt? What if you don't need a new car? Can you still benefit from this? Should you still become your own banker? And the answer to that is, oh, hell yeah, because that's where the fun begins. That's where it's time to start building wealth, creating a legacy for you. Watch this. When it comes to creating wealth, there's 2 things that I found that are mandatory. I'm going to call these laws. The other ones were rules. These are laws, because every single person I've ever met that's successful, that's a multimillionaire, they abide by these two laws right here. Number 1, compounding interest. In fact, Albert Einstein said it best. Albert Einstein called compounding interest the 8th wonder of the world. He said, those who understand it use it, those who don't pay it. Which one are you doing? And then how about uninterrupted compounding interest for the rest of your life? And then rule number 2, money movement and flow. See, money sitting still is losing. Money in motion is making more money. So every dollar I make, guess what I'm doing with it? I'm following these two rules, these two laws, with as much money that I make as I can. And how do I do that? By flowing it not into somebody else's bank, by flowing it into my bank. Remember, I'm not doing anything different, just where my money goes first. And by moving my money first into my own bank, it's allowing me to take advantage of both of these laws. Uninterrupted compounding interest while simultaneously I'm pulling the money out and I'm keeping that money moving, making more money. Whether it's buying another business, whether it's private money lending, whether it's buying more real estate, I'm keeping that money moving, making more money for me at all times. And we're able to do both of those things simultaneously when you become your own bank. In different ways that I'm doing it, through strategies, techniques that I've learned over the last 15 years, through connections that I made through my network that I share with you through Money School, through the Money Multiplier, through the various trainings and webinars that we do. So real estate investing, commercial real estate, private funds, private money lending, businesses, stocks, options trading, startup companies, crypto, note investing. Pick your poison. What are you good at? What do you specialize in? Let's get that money moving. Let's get that money making more money for you. It's as simple as that. It really, really, truly is. So here's an example of what we would call a high cash value policy. You know, how much do you want to fund your new bank with? You tell me. Like I said before, you decide how much you want to put in. Well, this was a lady, I think this was in Washington State a few months ago. She was 41 years old. See, she had just done a real estate deal and had $100,000 sitting there in her bank, earning nothing in a savings account. But she knew she wanted to use it for the next deal also. But she didn't want the money just sitting, earning nothing while it was sitting in the savings account. But she also knew that she didn't want to commit to $100,000 a year every single year moving forward, or even 150. She wanted to get the 150 in there. And then each year moving forward, she just wanted to commit to $50,000 a year. So we designed the policy, as you see on the screen, where she was able to dump in $150,000 the first year and then put in $50,000 a year for the next 9 years. And like I mentioned before, in the 11th year of this policy, you see how it drops down? But check this out. In the 11th year of that policy, can you see that right there? $17,500 goes in, and then skip over to the right side. Can you see over here where it says increase in net cash value? Look how much this thing increased in the 11th year, $45,000. She puts in $17,000 in the 11th year of this policy, and her account grows by $45,600. She didn't do anything but change where the money went first. But you tell me how much you want to put in. Here's another one. This was a 38-year-old male, and he wanted to dump in $50,000 up front, but then he only wanted to commit to $500 a month. So that's what we did. He dumped in 50,000 and started doing $500 a month into it. You tell me how much you want to put in. But look at this thing. When he's 62 years old, 281% cash on cash return within the policy that year. Access to cash capital of 381% of what he put in. I mean, these things just really start crushing it. So here's an example of investing with the policy. This is what we call the flow of money, okay? So we have our money multiplier insurance policy. And then let's say that I identify a private money loan that I want to make. And I lend to all my lending. I find all my borrowers through what's called the Private Money Club. And the Private Money Club is simply a community of borrowers and lenders. So people that need money, people that have money, lending to people that need money. And we do so because our money is protected in a first lien position mortgage, just like banks do. We do so because it's protected by that asset, because I make sure that it's a good deal before I lend my money, that whatever is securing my money is worth more than that loan that I'm doing. And because I can make great returns, I can make 10, 12, 15, 18% returns by doing this with my money. So the Private Money Club, if you're looking for a source to lend money or even get money for real estate your deals you're doing, that's an excellent resource right there. It's what I personally use. So when we take, so just to show you the flow of what this looks like. So we take a loan from the policy. Let's say I need $23,000. When I take a loan from the policy, the insurance company is going to charge me 4 to 5%, depending on the company. That money goes into what we call a segregated account. So this is just a plain old checking account at whatever bank that you already do business with. This is kind of like a little temporary holding account. So the money goes from my policy into my segregated account. And then from my segregated account, I'm going to wire it to that private money deal, to the escrow company or the attorney that is handling the closing for that deal. Like I mentioned before, 10 to 15 to 18%. So most common 12%. So I lend my money at 12%. And then the borrower starts paying me interest on a monthly basis. So now I have monthly payments coming back into my segregated account. From there, what am I going to do? Well, I'm going to keep the spread. So if I'm paying 4%, let's say 5%, and I'm earning 12%, I'm keeping a 7% spread. So what I'm going to do is I'm going to keep that spread to do whatever I want to do with it. And then I'm going to recapture the rest of the money right back into the policy so I can do it over and over and over again. So just a quick little example right there of the flow of the money. So here's an example of a private money loan using that exact same policy I just showed you. So check this out. Let's just say it's the 8th year of the policy and they want to do a private money loan. Well, in the 8th year of this policy, the policy grew by $66,000. To get that growth, I had to put $48,000 into it. Okay, so I put $48,000 in, grew by $66,000. Let's say I identify a private money loan. So then what I'm going to do is I'm going to take a loan from the policy for the private money loan, and I'm going to do that at 12%. So let's do the math here. My policy in the 8th year grew by 37%. I'm taking money out and I'm earning 12% on the money through the private money deal. I'm paying the insurance company 5% to be able to use that money. And I just made, if I did the math correctly, 44% on my money. So let's do a little comparison here. If I would have taken that money from a Wells Fargo savings account or business account and lent it on the private money deal, I would have made 12%. By taking it from my bank, because of uninterrupted compounding interest, I made an additional 32%. So what would you rather make? Would you rather make 12% on your money or 44% on your money? We didn't do anything different, just where our money goes first. And that's what becoming your own banker is all about. So when it comes to these policies, just the last couple little things here, the death benefit is tax-free and creates a legacy for you and your loved ones. The loans never have to be repaid. You set the terms. The loans are also tax-free. The internal growth of this thing is completely tax-free. The policies are exempt. Your money's protected. They're exempt from judgments and liens in most states. Oh, and by the way, we didn't even talk about using these for your business. So if you have a business, big business, little LLC, whatever it is, remind me, and I'll talk to you about the different, how to use this for business and the differences of using this, loaning money to your business versus an actual company-owned life insurance policy. So there's pros and cons to doing both of these and how we set them up and the way we use the money. So I can talk to you that on a phone call. So just remember to ask me about it. And kids policies are fantastic. Anybody planning for college, for purchasing cars for kids, setting them up for the future, for business. These kids policies are unbelievable. I started one for my 5-year-old last year. He's 6 now, but almost 7. But I started it for him last year when he's 5 years old. And this thing is amazing what it does for him for college and buying cars and other expenses we have in life. So ask me about those too. Those are really, really cool and what they can do for you also. All right. So again, I don't want you to think of this stuff as excuses anymore. We're going to eliminate volatility by putting our money in guaranteed vehicles. We're eliminating inflation by keeping our money moving at all times. We're taking advantage of all the tax strategies we can. Like I said, tax-free growth, tax-free loans, tax-free benefits. We're going against with the 95. We're joining the 5%. Every one of you, you're joining the 5% right now. We're not letting life, we're not letting fear stop us or get in our way. We're going to meet our goals no matter what. Those are the people that I want to work with. Just listen to Warren Buffett. If poor people would just do what rich people do, they wouldn't be poor anymore. But seriously, we're mimicking what the banks do. We're mimicking what the wealthy do. It's that simple. This has been used for over 200 years. So ask yourselves these last 2 questions. Are you better off with or without this while you're alive? And are you better off with or without this once you pass away? And if you feel like you're better with this on both of those questions, then I would love to talk with you. So what you're going to want to do is either send me a text message, an email, or just go to that website right there, moneyschoolrei.com/Snagi. And my calendar is on there. So you can schedule a call with me. Let's hop on the phone. Let's talk about your personal situation, what you have going on. Let's get this set up right for you and your family. I'll answer all of your questions. And if it makes sense, great. Let's get it moving forward. I would love to help you become your own banker. All right, cool, guys. Well, thanks again for being here. Just please reach out to me if you have any questions. Get that call scheduled. I'm here for you. Join us tomorrow for a full day of webinars. Starts off at 9:30 a.m. Eastern with the What the F Happened live stream podcast. Join us at 1 p.m. Eastern for the Wealth Webinar Series, 4:30 for business building and precious metals. And then next Monday with the Private Money Club Mondays at 1 p.m. Eastern. Other than that, hope you guys all have a great week. Happy Labor Day weekend this past weekend. We'll talk to you soon. Thank you. Bye.